place to go to check out is msnmoney.com. They have some great charts. They're all fact-based charts, and you can sort of see for yourself, what's really going on with these, big picture statistics that are arguing that the stock market's not the place to be, or it is the place to be, or gold, or whatever the, investment of the moment might be. Very useful. Now, going along with that, watching out for the sneaky statistics, also watch out for people who sell performance, correct? Because, that's also easily manipulated. Brokers love to sell performance. Mutual funds love to sell performance. Even financial advisors who are fee-based fall into the trap of wanting to sell everything based on performance. The problem is they're not all using the same measuring stick. So some might be quoting average returns. Others might be quoting something called total returns, which might include dividends reinvested over time. There might be time-weighted returns or dollar-weighted returns. And what difference does it make? At the end of the day, a lot, because it's a totally different number. The reality is you want to be looking for something called real returns, and that means you're really comparing an apple to an apple. And one way to really check that out is go to Investopedia.com. They have an excellent explainer about how to really get down to understanding real returns. And then when you're on the telephone with your broker or your financial advisor or the mutual fund company, ask them to quote you only in the real returns, so that you are comparing an apple to an apple. So be careful on performance. Investopedia.com, you said. All right, good website to know. Now, another thing to watch out for is becoming your own financial advisor. Why is this dangerous? Isn't it good when we take our finances into our own hands? Yeah, and here's something I'm guilty of, because I tend to be the one to say you can be your own best financial advisor. It is not the same as saying you can be your own heart surgeon. Mm-hmm. That's not what I'm saying. But the fact is that you're going to hear financial advisors out there say, no, you can't possibly understand everything you need to know. It's a full-time job. Don't even try this at home. Or you're going to have people say, I can do everything myself. The truth really lies somewhere in the middle, and it really depends on who you are, and it depends on your interest in the topic, your interest in your own money. But I'll tell you one thing, learning the basics and the fundamentals, that goes a long way toward you being able to at least figure out your own strategy. Because at the end of the day, if you can figure out what your strategy is and answer the question, what do you really want out of an investment portfolio over a lifetime, you're halfway there. Right. And understanding the basics is pretty easy. My book, The Money Track Method, is available. That's a really good primer on just understanding what you need to ask and what you need to know to get the basics. But the bottom line is, I do think that you can be your own advisor. But I also think that financial advisors who are good and fee-based provide an invaluable service. And maybe the best way to think of it is that when you're using the financial advisor, have that advisor teach you along the way so you're not left in the dark. And I think that's the important thing. Very good advice. In this segment, Pam joins us to answer some viewer questions. All right, Pam, thank you so much for sticking with us. The first question comes from Graham of Glen Mills, Pennsylvania, and he writes in saying, I want to invest in a 10-year Treasury bond at least 3% and sell it in 3 years. I know that if the rates are up in 3 years, the difference will come off the principal. Do you think this is a wise move? Also, do you think it is worth waiting for the rate to get to 3%? Pam, what advice would you give Graham? Okay, two separate questions there. But, Graham, it sounds to me that if you're looking at a 10-year Treasury bond, or Treasury note, you're really looking at sleep-at-night money here. This is not put it on the roulette wheel and see what happens. So your idea is pretty savvy. You're taking a 10-year bond and you're saying it's paying 3%, where probably if I put it in a CD at the bank, I'm going to get half that, if that. So let's say it's a $10,000 investment, $300 versus $150. Sounds like a no-brainer. Problem is that if interest rates do move up, which, you got to ask yourself, what's the likelihood that interest rates are going to go down from here or stay the same? Likelihood is they're going to move up in the next 2 to 3 years. You will get caught in that trap of having to then resell the bond on the open market, and you will take a hit when you do try to do that, because that bond will not be as attractive because everybody else will be getting 4% at that point and your bond is only offering 3. The difference is going to come right out of your principal. Your little inner voice is talking to you here. Listen to your inner voice. I wouldn't do it. I wouldn't take that risk because it is sleep at night money. Better to instead consider Treasury inflation protected securities. You can go to treasury.gov and learn a little about those. I would take a little bit of a patient stance on this because I feel personally that the likelihood of interest rates going up over the next couple of years is going to be pretty good, even if it's just a little bit. And you can put your money in that CD in the meantime and just kind of wait it out just a little bit. So I say practice patience here, go for safety, and definitely look at treasuries that are protected for inflation when inflation does become an issue down the road.
Right.
So treasury.gov, and good luck with that.
All right, Graham, so wait it out a little bit. All right, now Miranda of Pensacola, Florida writes in saying, I'm 27 years old and I'm making a decent living and investing in my company's 401k to the max that my company matches. I want to know what else I should be doing to secure my financial future. Just putting money in a savings account doesn't seem to be cutting it. What do you say, Pam? You love questions like this, don't you?
I love Miranda. She's an inspiration. She's an inspiration for all of us. I mean, 27 years old, and what living within her means to the point where she's really think about it. She's probably not making, maybe I'm wrong, but she's probably not making, lots and lots of money, and yet she has this money left at the end of the month to invest in addition to the money she's putting away in her 401k. That is amazing. So, very, very savvy of you to be taking full advantage of your employer's generosity with that matching contribution. I would look at a Roth IRA for the rest of the money at the end of the month that you continue to want to invest in a tax-deferred or a tax-favored environment. You can go to rothira.com to find out if you're eligible, but I'm willing to bet that you are because you have to be making about $120,000+ a year before you start to become ineligible. So as long as you're making under $120,000 a year, you can probably do that, which means you can have both the 401k and an IRA. And you might be wondering, well, why not just put the rest of the money into the 401k? And I'll tell you, the Roth IRA is wonderful because if you're 27 and you're thinking about buying a house in 5 years, think about that. You can get the money out for the down payment on the house much easier with the Roth IRA. So look into that, and all I can say is you are my hero.
Right. More power to you, Miranda. All right. All right. We don't have a lot of time for this last question, Pam. This is from Ann of Livingston, New Jersey. She writes in saying, I have $25,000 that I want to invest in my son's future college education. What's the best savings plan to put the money in, and how much could I realistically make in the next 3 years on that type of an investment?
Oh, okay. Easy answer, real short. 3 years, you can't go into the stock market. That means go into CDs that have maturities of 2 to 3 years, lock it up safely. $25,000 is going to go a long way toward helping offset those costs. But 3 years, no stock market. Keep it safe. Safety first.
And then what?
And then she can start to withdraw the money as she's going to need it, because 3 years' time is when her son is going to need the money to start spending it for school.
And no taxes?
No. In a CD? No. There'll be taxes.
Right. Okay.
She'll have to pay taxes. She can't take a risk on putting it anywhere but like a really super safe bank account because there's just not enough time.
All right, Pam, thank you so much.